I'm going to be presenting the paper with Nick, titled "Do Common Factors Really Explain the Cross-Sectional Returns?" And by the end of the presentation, I'm going to try to convince you that investors do not care that much about systematic risk, about covariance risk, and that's going to be extremely puzzling, and that's going to be extremely bad for arbitrage pricing theory. To the computer. Okay. So the big picture is saying that if we go back to arbitrage pricing theory, it just says that something very sensible, right? That securities earn higher returns only because they're more exposed to some risk factors. So inflation could be one of them, right? In this case, APT is very specific, and it says that securities earn higher returns because of exposure to common factors, to factors that drive the covariance structure. Now, conversely, the expected return of diversified portfolios that hedge all of this systematic risk should be exactly 0, right? At least in the limit as we increase the number of assets. And of course, APT is the foundation of empirical multi-factor models, and it's widely cited. Now, why is it hard to test APT? Well, because when we're dealing with individual stocks, it's very difficult to estimate the covariance matrix, right? Like we normally won't even try to do anything regarding individual stocks because of the covariance structure, right? So of course, whenever there's a proposed factor model and then there's a new anomaly, we don't really say that none of the factor models work. We just say like, okay, maybe that specific factor model needs some specific work and adding something that captures the structure. Right? And also the fact that expected returns are unobservable doesn't make it easy to test whether the portfolios that are sorted ex ante on expected returns are going to have interesting properties. So our contribution is going to be that we combine an efficient method to measure individual stock betas. So for every stock, we're going to have its beta with respect to every latent factor driving the covariance structure at every point in time. So these are going to be dynamic betas. We're going to combine that with out-of-sample measures of stock predictability. So we're going to try, and for the main analysis and in the main results in the paper, I'm going to try to use machine learning to predict returns, but results are similar using linear regressions. And of course, everything's going to be out-of-sample. And we're going to use pure plays to hedge all of the systematic risk while sorting on expected returns. Our main finding summary is that portfolios that hedge systematic risk will perform better than portfolios that have more systematic risk. Now that sounds very puzzling, so I'm going to go the whole presentation about it. The main reasoning is because latent factors, the factors driving the covariance, of course, by design, explain a large time series variation of stock returns. They explain why stocks move together. But they're going to be incredibly bad at explaining the cross-sectional differences in returns, right? Now, that means that these latent factors will probably not have a high factor premium, a high expected return. So if you hedge them, you'll essentially be reducing the variance, and for that matter, the systematic variance, while maintaining the same exactly expected returns, right? And that's going to be extremely puzzling because that's going to, of course, push the Sharpe ratio to be very high. Now that sounds very weird, but it's going to sound very normal by the end of the presentation. Of course, we're building a ton of related literature, factor models, cross-sectional return prediction, the characteristics versus covariance debate, and of course, I will not have time to make it justice, but we're building on a lot of very nice papers. Now, just to fix ideas, and I'm sure the people in the back of the room cannot see the equation, but at least for the front. So what APT is saying is essentially that we can model the expected excess returns as average return plus some factor exposure plus some idiosyncratic noise. Idiosyncratic in the sense that the covariance of the idiosyncratic noise between stocks is 0, right? And the main bite of the APT is that the factors are going to be the same factors that drive the covariance, and that, of course, there cannot be any excess returns unrelated to this factor exposure. The expectation of the return cannot depend on anything else than the factor exposures. Why? Because otherwise we can build a classic long short portfolio with an extremely high Sharpe ratio, right? And it's simple. Like suppose you have two portfolios with the same beta, right? So that you can hedge them. But those portfolios differ in their expected excess return, right? So you would, of course, go long on the portfolio with high excess returns, go short on the portfolio with low excess returns. That would cancel the betas, and you would essentially have like a near arbitrage portfolio. And the Sharpe ratio of this portfolio would grow at a rate of like square root of n. So because of, with individual stocks, we have like 3,000, 4,000, turns out that's a large number, right? And remember that the Sharpe ratio is going to have implications because of the Hansen-Jaganethan bound. So we involve everything here. Right, so of course what I thought would be interesting, and what like Nick was telling me too, is we're going to form zero cost portfolios with high expected excess returns and zero beta exposure, right? So exactly what we want. We need two things for this. We need the expected excess returns, which we're going to get either from predictive regressions or from machine learning rolling regressions, and we need the covariance, which is why we need this very efficient method, because we're going to get like rolling betas at every point in time with respect to every stock, with respect to every factor. And of course, that's going to be a little bit hard to estimate. So for expected returns, I'm not going to elaborate a lot because we don't really do anything weird. So we're just taking advantage of the existing techniques. So we're going to forecast returns at time t plus 1 using a subset of variables available at time t, right? Exactly a prediction, exactly out of sample. We're going to implicitly model the conditional expectation as a possibly nonlinear function of characteristics available at time t using random forest regression. Why random forest regression? Because it's a standard toolkit that gives you nonlinearity and it's able to handle high dimension. Could we do this with linear regression? Yes, it would also work. But in practice, this was the first choice. I think the results with linear regressions may be even stronger, which is positive. We are, of course, going to use out-of-sample prediction, right? And the way I would like you to think about supervised machine learning, it's just a prediction machine. It receives the public information at time t, and it throws you out a forecast, right? In practice, the best possible forecast is literally the conditional expectation, right? So we cannot really obtain exactly the conditional expectations, but we're going to use machine learning to try to approximate the conditional expectation as best as possible to predict out of sample. And it's just going to be a nonlinear function of the information available at time t. Information we're going to proxy with characteristics, and we're going to fit the nonlinear function using the information up until time t, and then predict out of sample for the t plus 1. So this is very similar structure as rolling regressions. And we're going to be training the model every 5 years and then predict the next month. 5 years so that we are mindful of any change in the systematic structure of the expected returns. Now for conditional betas, which is the interesting part to me, so we're going to use betas with respect to the latent systematic factors exactly to try to absorb as much as the variation as possible. We're going to use 1 year rolling windows of daily returns because we want to address time-varying betas, right? Because one of these excuses could be like, okay, maybe APT is holding conditionally and you're not using time-varying betas, so we're definitely going to try to address that. So just to give you a little bit of context, let me just see. Okay, I'm doing great with time. So if we think of the return matrix, just called R times T, so like we're using daily returns, so 250 days, and N, where N is like 4,000, 3,000, depending on the specific year. We're going to demean that matrix as it's customary to obtain like the principal components. But importantly, we're going to see that you don't really need to go to the whole covariance estimation to get the latent factors. You can just extract them using the return matrix, right? And the intuitive reason for this is that the covariance matrix is going to be R prime R, so R transpose R, and it cannot contain more information than R, right? Like all of the information is already in the matrix of returns. To do that, if you recall the singular value decomposition, where you would get R as a combination of as the multiplication of three matrices, so U, S, and V, where U and V are orthogonal, so like U prime U is equal to V transpose V is equal to the identity matrix, and S is diagonal, which is nice. Normally, what you would do, you would get the you would get the principal components from the covariance, right? What I'm going to show you is that the betas, exactly the same betas, are just contained in the right singular vector, so in the matrix V, and you don't need to do anything else, right? So the covariance, in this case, is going to be funny, right? Because we have like 4,000 stocks. So the covariance matrix is an object of dimensions 4,000 times 4,000, so millions of parameters, right? Like, you don't really want to estimate that, right? Of course, it's going to be extremely singular. Like, you cannot even try to invert it. If we just look at the eigendecomposition, then we're going to have a clue of what's going on. The covariance matrix essentially can be thought as a function of V, some lambda matrix that's going to be extremely related to S, and the same V transpose. Of course, the principal components are going to be the projections of these V's onto the returns. So R times V. The covariance of the returns with the principal components is just going to simplify to V lambda. And the variance of the principal components, almost by linear algebra magic, is going to be lambda. So when you do the covariance times variance inverse, you're going to end up with that the projection of the returns on the factors or the betas are exactly going to be the right singular vectors that I showed you earlier. All of this to say is that you don't even need to worry about covariance. You can just run this using the return matrix, right? That's going to be important in our application because we're going to do a lot of computations to do this in a rolling fashion way. Now, there's some caveats that I want to be mindful about. So the latent factors will only be identified up to rotation, right? Like, that's well known. Like, you can always rotate any factor model, right? Of course, the same is true of the betas, right? If you multiply your factors by something, you need to multiply the betas by the inverse of that to keep consistency. So what we're going to do is we're going to try to track them as close as possible by normalizing the average beta with respect to every factor to be positive. So that's an extremely mild assumption, and it's just a normalization. In any case, because we're going to try to hedge all of the betas, it doesn't matter which rotation you pick, because once you hedge, once you make the betas equal to 0, any rotation of that is going to be equal to 0 as well. So that's something lucky for our application. Now, there's also a question of timing. Technically, the latent factors, you can only observe the realizations at the end of the period, right? Whereas the betas are normally thought at the beginning of the period. So what we're going to do is, to avoid any out of sample, we're going to forecast the realization of the betas using a simple 3-year rolling panel model to obtain out of sample results. There's nothing special about the 3-year rolling window. 5 years, 10 years work as well. The reason being that betas are relatively stable month to month, and this is especially true for the betas with respect to the factors that capture most of the time series variation. Right, so we're just going to use the cross-sectional information for 3 years to estimate these loadings and then predict out of sample. And I'm going to show you a graph that this does a reasonably good job of addressing that. So far, we have these very two cool objects. We have the proxy for the conditional expected return at every point in time for every stock, right? And we have the betas with respect to the latent factors at every point in time and with respect to every stock. So what we want to do now is want to form portfolios that are as diversified as possible while sorting them on expected returns, and with them having the property that their betas with respect to all of the factors, or as many factors we want to hedge, is going to be equal to 0. To do that, we're going to use something that's called pure play that was popularized a long time ago by Fama, but then I found out because Kerry had a very, very nice working paper on that, which I also use for my job market paper. So let me just explain a little bit, and it's also because the previous presenter asked me to. So what we're going to do is we're going to try to form as diversified portfolios as possible while having a certain expected return and while having the betas equal to 0. So let me go very, very slowly. So the most diversified possible part means that you're going to minimize W primes times W, the dot product of W, because the unconstrained solution to that is going to be the portfolio with weights 1 over n, with equally weights, right? So that's as diversified as possible. And then we're going to introduce a couple of restrictions. So the first restriction is that the portfolio weights sum up to 0. We could also do it with summing up to 1, but then the interpretation gets a little bit different. So let me just do it with summing up to 0. First, we're going to want that this portfolio have a given expected excess returns. Now, importantly, we now have a measure of expected excess returns, so we can just take the weighted average of that measure to be the expected excess return. And the most important restriction is that the betas of these portfolios are going to be equal to 0 for the first k factors, right? So k in practice is a number that runs from like 50 to more. So I'm going to show a little bit of that, right? It turns out that we can collect these restrictions in a nice simple matrix called A, which has like a vector of ones, the vector of expected excess returns, and the matrix beta. And we can just do a little bit of linear algebra, and the solution would look awfully lot like the Fan-Macbeth cross-sectional regressions, right? So this is just another way to restate the Fan-Macbeth cross-sectional regressions. So this is extremely nice. For the data, we're not going to do anything fancy. We're going to use CRISPR. We're going to use CompuStat. We're going to use the period 1965 to 2014. But I'm going to use the first years to train the model. We're working on expanding the sample, and preliminary results suggest that it's exactly the same. We're going to be using the predictions from Freiberg, Neuhel, and Weber. And we're going to standardize them cross-sectional each month. Again, we're not doing anything weird here. So the first thing we want to do is like, of course, I told you like we don't really need the factors, and the factors themselves are just a statistical object. Like they don't have portfolio interpretation. So to make them easier to study, we're going to provide a portfolio interpretation of them by projecting them onto return space using pure plays, right? So the projections are going to have beta of are going to be like 0 weight, like long-short portfolios. And they're going to have a beta of 1 with respect to, the factor k is going to have a beta of 1 with respect to factor 1, and then a beta 0 with respect to all of the other ones, right? So this is going to be very similar to long high beta, short low beta. So that's the intuitive way to think about it. We're just making sure that the other betas do not interfere in the identification, right? We choose to make them 0 weight because if we make them unit cost, then the portfolios are going to look a lot like the market. Like, in fact, the first portfolio is going to be almost the market, like 95% correlated with it. Again, in practice, we're going to hedge all of the betas, so it's just for theoretical reasons. Right, so the factor pure plays, and because I already built the algebra from this, I'm just getting the time here. I'm going to go a little bit faster. So we're going to have diversified portfolios as possible, 0 weight, and the portfolio J is going to have a beta J of 1, and all of the other betas are going to be 0, right? And we're going to use this using the pure play technique. The first very interesting result that we have is as expected, the full covariance of the individual stock returns is very high dimensional. So normally we're used to dealing with portfolios, right? And because portfolios are diversified, they have like an easier covariance structure. In this case, the covariance structure of the individual stock return is going to be very high dimensional. So the first factor is going to count like 15 to 20% of the variation, right? The first factor is roughly the market portfolio in some sense. But then the rest of the other factors just like increase very slowly. Like there is no obvious like threshold, right? In principle, we could do a formal test at the end of the sample to see how many factors we have, but then you cannot use that information at the beginning of the sample, otherwise you'll be incurring in forward-looking bias. The good thing is that, remember I told you we're gonna use the out-of-sample prediction of the betas, right? And in fact, you cannot even see the difference here. So the actual using the actual realized betas, like exposed, or using the prediction of the betas, essentially gives you the same time series R squared. In other words, we're like, because betas are not changing as fast, like month to month as returns, right? Like covariances are more slow moving than average returns. Then we're going to have that we can roughly explain the same variation using either the explained or the actual real or the reconstructed ones. So the first puzzling and unpuzzling graph is that almost not. So if I'm plotting here the cumulative log return of the zero cost latent factors for all the sample, and the market in green on top for comparability. So we roughly say that none of the factors really get like a high compensation during this period, right? if you think a little bit about what has been done, it doesn't sound that puzzling because, for example, we know that the security market line is very flat, or flatter than it should be, right? So the portfolios that go long on stocks with high beta and short on stocks with low beta usually do not get a high compensation for return, right? Like that's a well-known fact. That roughly corresponds to factor 1. But if you think that investors are not compensating the first principal component, the first latent factor, it will be a little bit fun if the factor 13 just suddenly gets like a huge increased compensation. So in some sense, this is not that unexpected. Like we have tons of literature documenting that systematic factors are not good, are not being like as priced as they should be, right? Like the security market line is flatter, it's way flatter than it should be. So in some sense it's puzzling, in some sense it's not. The problem, of course, is that if you're exposed to these systematic factors that are not earning any expected returns, what any investor should do is hedge them completely, increase the Sharpe ratio, and don't lose any excess return, right? But of course, the problem is that that is very, very much against what I showed you in the beginning of the slides, which says that portfolios should only earn higher returns because they're more exposed to systematic risk, right? And that portfolios that hedge all of the systematic risk should get 0 returns. So that's the puzzle. Oops. Here I'm just plotting the descriptive statistics, just a little bit more formal. So the average returns is very close to 0 when you do zero cost portfolios, so high beta, long high beta, short low beta. And of course, when you do unit cost portfolios, the patterns are going to be different because you're roughly going to be adding an equally weighted portfolio, so the average risk premium actually turns positive. Right, and as I was mentioning, the intuition is that the leading factors carry a high variance, both by design and because the reconstructed betas do a good job, but they do not carry any substantial risk premium, right? So hedging portfolios against all systematic risk reduces variation without reducing their return. Or conversely, hedging portfolios against all systematic risk increases their Sharpe ratio, right? Which sounds very, very puzzling. So this is our main table. I like to keep it short. I'm just going to show you that the average returns of the market for comparability, the long-short portfolio, so a portfolio that's long on expected excess returns and short on stocks with low expected excess returns, and one portfolio that is also sorting on expected excess returns, but it's also hedging, in this particular case, 50 factors, right? So the average monthly rate of return for the market during this period was like 50 basis points, the standard deviation 4.65, and the annualized Sharpe ratio is close to 0.4. In contrast, for the long-short portfolio, we get a higher average return, so we get 0.72 basis per month. The standard deviation is lower, and the annualized Sharpe ratio is like already higher than the market. Now, there is nothing wrong with this portfolio so far because the returns of this portfolio could be explained by covariance with other factors, right? In particular, it could be explained by using the systematic covariance. Now, the puzzling case is going to be what I call the beta neutral portfolio. That is essentially a long-short, long on high and stocks with high expected excess returns, and short on stocks with low expected excess returns. Right? And it's going to hedge the first 60 factors by making the portfolio beta with respect to these factors equal to 0 using the pure play technique. So this portfolio has roughly the same average excess return as the long-short portfolio, unsurprisingly, because I show you that none of the first factors gets compensated anyways, but that's going to make it so that you can essentially make it in half, the variance, and furthermore, this is systematic variance, like this is the kind of variance that investors should concern about, and as a consequence, the Sharpe ratio just doubles, right? Now, a Sharpe ratio of 1.51 is extremely problematic because, well, it's like almost 3 to 4 times as large as the market, and because of the Hansen-Jaganathan bound, consumption asset pricing based models would have a very hard problem explaining this, especially if it doesn't covariate with the market or with any of the subsequent returns, right? In practice, I told you I chose 50 because the cumulative percentage of variance explained of the latent factors grows very slowly. It doesn't make that much of a difference. So after you hedge like 25 portfolios, you're essentially as good as if you hedge 100. Furthermore, because we're predicting the realized betas, right? In this case, when using 50 betas, I have to predict like 50 betas every month. When using 100 betas, you have to predict 100 betas every month, so the estimation error gets larger, and there's like a threshold at which you can like stop. So that's good. The Sharpe ratios are not infinite because we have a bounded number of stocks. Let me just show you quickly the cumulative log return of the portfolios. So the red line, the more spiky line, is going to be the long-short portfolio. It has a very nice return, especially pre-2000. The blue line is going to be the beta-neutral portfolio, the hedged portfolio, which is essentially a very smoothed version of that portfolio, right? You're just taking the properties of a portfolio with high excess returns and hedging all of the betas, and then the market for comparison. And again, the puzzling result is the blue line, the smooth line, because that shouldn't be the case. If we break the return into two samples, before 2000 and after 2000, well, it's very interesting to see that the long-short portfolio is getting all of its excess returns from this part of the sample, right? The interesting part is that the beta-neutral portfolio still like halves the standard deviation by hedging all of the factors. So the Sharpe ratio, it still doubles, right? So these Sharpe ratios are very, very large during this period. After the 2000, and presumably because of more market efficiency, because of publication, etc., the long-short portfolio, sorted on expected excess return, actually works bad, right? Like you cannot use those variables anymore to predict the excess returns in an efficient manner, at least using random forest regression. So the returns of that portfolio are going to be essentially zero, even a little bit negative, but not significant, while the returns of the beta-neutral portfolio not only get positive, but of course, because you're hedging like half of the standard deviation or a little bit more, you get a Sharpe ratio as high as the market Sharpe ratio in the previous sample, right? So that's extremely puzzling. So on one side, we have the good result that return predictability is declining. On the bad side, we have the, well, unfortunate result that the return predictability seems to be declining because this long-short portfolio is loading on factors with negative price of risk on average. So when you hedge them, you again recover a very nice portfolio. Now again, this is super problematic because investors should not be rewarded by hedging portfolios, right? It should be the opposite. Like they should be getting compensated by holding portfolios, right? Sharpe ratio is almost 4 times the market, depending on the sample. I mentioned several times that the Hansen-Jaganathan bound makes it extremely complicated for consumption asset pricing-based models. Of course, these latent factors cannot explain the returns. So what about reduced form factor models? Well, as expected, they cannot explain the returns, right? So there's going to be an alpha even from the long-short portfolio using either the CAPM or the Fama-French 5-factor model, but the statistical significance of the alpha is going to grow in magnitude, like standard deviation gets by half, so the t-statistics almost double. So you get from like a t-statistic of 4, which is great, to a t-statistic of 8, in which there's no combination of things that you can do to generate these statistics, right? The same holds for the Fama-French 5-factor model. Interestingly, the models by Lou Sangs and the model by Robert Stambach can actually explain the returns of this long-short portfolio. But unfortunately, they fail very, very badly at explaining the returns of the beta-neutral portfolio, as expected, right? Like we're hedging all of the systematic variation, so we would expect to reduce a lot the ability of these factor models to explain these returns, because these factor models are based on matching covariances, right? So that's a property. It's not a bad thing for the models per se, because it means that these models are actually capturing a big source of systematic variation. It just happens that this systematic variation is not priced, so when you run hedged portfolios, you get a way, way higher alpha with a way, way higher statistical significance. Same holds with value-weighted time series regression, etc. How much do I have? 1 minute? 1 minute. Yeah. So there's like this debate of characteristics versus covariance, right? And a lot of models model returns as a linear function of characteristics. That seems to be a very good idea, right? Because if you model the returns as linear characteristics, it doesn't matter whether it's the betas that are linear in the characteristics or it's the actual characteristics that are driving the excess returns. So that makes them very good, very efficient. The problem with that is, of course, you cannot disentangle whether it's being driven by the systematic variation, which is what we do. So just let me conclude. So taking zero systematic risk should produce zero returns, but in fact creates returns at least as high as when taking systematic risk, right? And this gives you, of course, by decreasing the systematic variance, Sharpe ratios that are 2-4 times as large as the market. This challenges a lot the arbitrage pricing theory because, well, we essentially say that none of the latent systematic factors are priced, and if you hedge them, nothing happens. In fact, it's actually good. And popular factor models cannot explain the returns, but at least the predictability seems to decline. Thank you very much.